Well, stocks on Wall Street notched their second weekly gain in three last week as buyers emerged in the Treasury complex as well, although the FX market remained somewhat more range bound. That, of course, before a renewed round of tariff rhetoric came late on Friday and over the weekend, spicing things up a little bit as the new trading week and, of course, the month of June get underway, with a busy data docket lying ahead over the next 4 or 5 days, including policy decisions from the BoC and the ECB and a whole lot of economic data as well, highlighted by Friday's US labour market report. Plenty to discuss on the trade-off this week, so without further ado, let's crack on with the show. So after a couple of weeks of calm on the trade front, we awaken and start the new trading week with a barrage of tariff headlines once more. Joining me to try and make sense of that and everything else that's going on is Ryan Littlestone from Forex Flow Live of Forex Analytics. Ryan, a very good afternoon to you, and I'm pleased to see you got the memo about blue shirts this week.
Yeah, it must have been a job lot sale on, but yeah, you probably getting the two of mine, but there you go.
I was going to say, if we start wearing the same shirt size, then one of us needs to be very worried into.
Yeah, I'll slim into yours. You can fatten up into mine. That's the way to
go. Oh, dearie me. But a fortnight away, certainly the markets haven't been calm in that time, have they?
No, I keep going to bed with the markets doing one thing and waking up in the morning and they're doing something completely different. And that's just markets at the moment. So you've got to remain very nimble and with your trading. And yeah, hopefully you don't feel like you've worked a week each day.
Yeah, absolutely. I was thinking more like a month, to be completely honest with you. But there we are. Some of us work harder than others, mate, it would seem.
There's the first one. There's the first one.
I thought they were for Kyriakos, not me. Right, enough of that. Let's get on with topical thunder. Thin ice for the rest of the program. Now we might have to call in VAR at some point to help me out. In any case, let's get on to the issue at hand, which is, of course, trade. Here we go again with all of the tariff nonsense. And market participants coined a new nickname over the last fortnight or so while we were away, which is Taco. Trump always chickens out. To say the orange guy in the Oval Office wasn't particularly happy with that moniker is probably an understatement. When he was asked about that by a journalist last week, he said it was one of the nastiest questions and things he's ever heard in his life. But to be completely honest, the evidence suggests that he does always chicken out. And in fact, the timeline for U-turns to take place seems to be getting even shorter. A couple of weeks ago, or last week, forgive me, we had this threat of a 50% tariff on the EU from the 1st of June. Within 48 hours, he backed down and that threat had been punted down the road to the 9th of July. So it seems that no matter how angry Trump wants to get about this Taco nickname, that is indeed the way that things are panning out. But having said that, things maybe aren't quite as rosy as market participants had hoped. We did have a little bit of a souring in the trade tone as last week wrapped up. First of all, we had Trump ranting away on Truth Social that China has violated its agreement with the United States. Now, remember, of course, no one's actually seen this agreement. To the best of my knowledge, all we had is a 3-paragraph press release confirming that tariffs have been rolled back on either side. But Wall Street Journal sources indicating that this is potentially to do with China dragging its feet with the issue of rare earth exports that is getting the US's back up a little bit. There was also some chatter via Bloomberg sources that the US was planning a bit of a wider crackdown in terms of sanctions on Chinese technology companies. And then very late in the day on Friday, after the markets closed the week and I was tucked up in bed, we had news that Trump was doubling tariffs on steel and aluminium imports to 50% from the 4th of June, which is, of course, this Wednesday. Now, despite all of that, I'm still firmly of the view that the peak in terms of chaos and uncertainty and volatility in trade policy is in the rearview mirror. And actually, the market market's sensitivity to all of this has lessened quite significantly. I think everyone is pretty safe in the knowledge that Trump is going to pull a U-turn very quickly and is dismissing his rants and his musings in relatively rapid fashion. I think fundamentally the deal is the direction of travel, forgive me, is one towards deals. It's one to calmer heads. And despite the noise, I think that remains true. And as a result, given the solid earnings season that we've just had with earnings surprising in terms of EPS expectations, 78% of firms beating on EPS expectations above the 5 and the 10-year average. Economic data is holding up pretty well as well. It seems like a pretty positive backdrop for risk to me, and one where, for me at least, dip buying in equities and playing things from the long side is still my preferred position.
Yeah, it's a positive territory for on landscape for risk. You wouldn't guess it looking at markets this morning, and as risk sort of craps the bed. China thing,
to be fair, we have recovered a hell of a lot of that lost ground already.
Well, depends what you're looking at. I'm looking at dollar yen, which is probably about 20 pips off its lows. It's already done, just over 300 pips since last Wednesday. So yeah, and yields aren't too bad, but yeah, I think there's the big difference with this bum fight, and particularly with China compared to Trump 1.0, is that they were reasonably quick to come to trade agreements. You remember the soybean stuff that we had to go through in that first round, but this time they're really sticking their feet down hard and saying, well, we're not that bothered. You can go and do what you want. Yeah, we'll give a little bit here, give a little bit there, but we're not going to come running to you. Trump's been pushing and pushing and pushing for this phone call with Xi, almost to the point of desperation in his rant the other day.
The Chinese are desperate for it. It's President Xi that's desperate to get a deal done and desperate to get on the phone. If you say that enough times, it becomes true, right?
Or maybe you can get an AI Xi to phone him up or something. But he keeps pushing this, and the Chinese just seem like they don't give a monkeys really. And I think that Taco comment has probably got Trump. It's probably worked in the opposite way. He's come out and thinking, well, that's what people are thinking of me. I need to come in hard with this steel tariff, and I'm going to stick to it. So if the market thinks he might, pull a 180 on this threat, there's a chance that he doesn't, and he follows through with it just to say to the market, hey, you don't push me around, you don't tell me how I negotiate. So I think we're in a little bit of a different situation at the moment. But overall, the big take that I'm getting from this is that last couple of weeks, as you say, we were heading towards, trade deals being done, easing tension with everyone. And then in a blink, we've got all that uncertainty and it's all blown up again. And from an investor's perspective, they're going, if we were looking to get back into US assets on easing tensions, this has just all blown up again. So why are we going to do that? So I think this risk off US, as we're seeing it, I don't think we're done with it yet.
Well, there we go. Takes two to make a market, as they say. We'll see which of us comes out on the right side of that in next week's episode. In the meantime, a busy week of central bank decisions up ahead.
Yeah, we got a couple of central banks, as you mentioned, Bank of Canada and ECB. So it is going to be an interesting week for those. We're going to start with the BoC. Bit of a strange one because largely we're expecting a 25 pip cut, and that's by most economists. But if you look at the current rate pricing, the probability is about 78% that they don't cut and stay on hold. So there's a bit of I think they're going to get a bit of an algo blip happening on this one. But the reason why the market pricing differs from maybe some of those economist expectations is really due to the recent data. We've seen much hotter CPI data. Last week, we had much better GDP data. And given that there's been no material change on the trade front, so the continued uncertainty for that, alongside with the data, has led the market to think that the Bank of Canada can afford to maybe sit on their hands for one more month before deciding to then go ahead and cut rates again. Suffice to say that this disparity between economists and market pricing, could be something that brings a decent trading opportunity on Wednesday, because those algos, if those calendars don't change, will be looking at that 25 pip cut. And if they don't cut, that's potentially going to create a bit of price distortion in the market. Then on Thursday, we have the ECB. It's pretty much a done deal that they're going to cut by 25 once more. So the real news is going to be if Queen Suntan indicates that maybe they're done with rate cuts for this little phase and they're going to go into a pause. Now, the usual hawks have been saying that they've done enough cuts, but we've also had some of the doves indicating that maybe they're going to be coming to picking a pause in the future. One dove, Pancetta, as we call him, Panetta, has said disinflation is now close to completion and prior cuts leave less room for more cuts, while another, Storneras, said they should be cautious on further cuts once rates hit 2%. Well, it won't be that big a surprise if they do pause for a while. It will shift the game to the data to see whether the data supports a pause or whether it indicates they're going to need to continue cutting. So it's going to shift how we watch data moving forward. The only other thing to look at is whether we can spot Michael's doppelganger at the ECB press conference, and I'll be looking out for that one.
I knew you were going to bring that up at some point. If anyone is at a loss as to who my doppelganger may be, I've forgotten the chap's name now, but a German journalist. We'll post a picture of him after the show, and you'll be able to see the rather uncanny likeness between the two of us, which. Yeah, we'll see if he pops up. That'll probably be the most interesting part of the presser, to be completely honest with you, as well as, of course, whether Vice President de Guindos is actually allowed to get a word in edgeways, because he's normally just sat there looking rather glum. In terms of the decisions themselves, though, I think could be interesting decisions this week. I think the BoC is certainly a live meeting in terms of market reaction when you've got that huge divergence between sell side consensus and what the market is pricing in. You could get a decent move one way or another. I would certainly lean towards the BoC remaining on hold. I don't think much has changed, as you said, on the trade front from last time out, and data since the last meeting has actually surprised to the upside. So you would kind of go, probably best to keep your powder dry for the time being and just hold off for another month in terms of a rate cut, if indeed you do think that further easing is required. I'll probably disagree with you a little bit on the ECB, though. I think everything points to them continuing to deliver rate cuts. If we get a 25 basis point cut on Thursday, that takes the deposit rate down to a flat 2%. But along with that, we get the latest round of economic forecasts. And if some of the sources stories we had last week are to be believed, we could be looking at an inflation projection next year as low as 1.7%, which is a pretty chunky undershoot of the inflation target. Now, you're smirking away. You can mock the ECB's forecasts for their accuracy as much as you like. The fact is, policymakers use that and base their policy decisions on it. So if you're presented with your staff and your chief economist saying, if you continue with rates at their current level or as how markets are pricing them, you're going to undershoot the inflation target substantially over the next couple of years, you're probably going to lean towards further easing. And that's even before you consider the fact that there's a very angry man in the White House prepared to throw 50, 100, God knows whatever percent tariffs on the block at a moment's notice. So I don't think we're near the point where the ECB pause or end the easing cycle just yet.
Yeah, and I always laugh at forecasts, whether they're central bank or otherwise, because we know that they're not usually worth the paper they're written on. But you are right, and you may recall I've been saying it since the beginning of the year that I still expect the ECB to have to cut rates lower than they want or expect, because inflation is really going to be weak. I mean, look at the PMIs today. France, one of the lines in there that I picked up on was that firms are cutting costs even more to try and get new business. And this is why you've got people like Vilroy pumping that there's more cuts to come, because they've got inflation at 0.7% or something, well below target. So they could be forced lower, but maybe they do a little pause just to see what happens at the next September forecast, because they like those looming forecasts, even though they're wrong most of the time. Now, I'm going to refrain. I'm stopping there before I start swearing.
Victor Meldrew has arrived from Bournemouth. You're absolutely right. The other thing I was just going to mention on the ECB is I think it's interesting that last time out, maybe the time out before, Lagarde has very much kind of rubbished the idea of this neutral rate range. Now, we spent most of last year going, where's neutral in Europe? And then they released this big study saying it's between 1.75% and 2.5% in terms of the deposit rate. Well, Lagarde has now actually started to go, given the uncertainty that we've got, that's not really a useful anchor in terms of how we set monetary policy. And I think that's interesting as well, because it just frames the discussion in a very different way. It's not, do we get to neutral? Okay, we're there. Do we now go below? It's a case of almost the question is, how low do we need to go in order to provide the adequate degree of support to the Eurozone economy, I think.
Yeah, and I'm not going to go on about it too long, but yeah, this neutral rate, we can really use it as the ideal place where central banks like to keep rates. So if they do have to cut rates through that neutral rate, we know where they'd like to get them back to once the dust has settled. So it's probably not going to be a huge amount of hikes if they need to get back to that neutral rate.
Indeed, yes. Right, moving on from that, as I alluded to earlier on, we do have, of course, the latest US labour market report due on Friday, referencing the month of May. As always, it is the most important jobs report that we've ever seen until the next one, as the way that markets work. In terms of consensus expectations for that labour market report, headline non-farm payrolls seen having risen by 125,000 last month is actually a little bit, well, it would be a slowdown from the 177,000 we saw previously, but it would be a little bit above the break-even pace of job creation, which is probably somewhere between 80 and 100,000 at this moment in time. And it's also just worth noting that the range of estimates is considerably tighter than usual. It's between 105 to the downside and 190,000 to the upside, which I thought was interesting given the degree of uncertainty to have a relatively tight range and a tight distribution of economists' estimates. You'll have to wait until midday on Friday for mine, though, as usual, Ryan. In terms of other, I thought I was going to get a card then. You were fidgeting.
It's waiting. In case you start having a moan up at my rules, it's waiting here, so I'm ready.
Oh, well, I was assuming that you might use this as an opportunity to concoct some sort of new rule to exclude me from the sweepstake once again. I've just come to expect that now, but, you know, I'll go and buy myself an envelope.
There it is. Second red, second yellow. That's it, you're off.
Right, that's me out. Where the hell was I? Average earnings, that's where I were. They're seen rising to 0.3% on the month from a prior 0.2%, but given a bit of a base effect from last year, that would drag the annual pace lower to 3.7%. So really not of any concern to the Fed. I think we all know at this point that upside inflation risk is coming from trade as opposed to coming from the labour market. And then in terms of the household survey, unemployment, that's expected unchanged at 4.2%, and that will be on unchanged participation at 62.6%. I would argue, though, just going back to that headline payrolls number, risks to the consensus arguably tilted to the downside. May was a very, very wet month in the United States, which could have a detrimental impact on sectors like construction and also leisure and hospitality. The other thing to bear in mind is in April, we saw two big contributors to the jobs gains we saw that month were, one, temporary hiring around Easter, which is likely to have potentially unwound this time out. And the second was a big surge in employment in transport, logistics, warehousing, basically sectors that really benefit from the surge in imports from all of the tariff front running that we saw. Well, most of that would have likely come to an end by the time of the May survey. So again, a potential drag in terms of payrolls growth from that as well. Having said that, if we did get a report in line with consensus expectations, that would be a very, very solid number indeed. And in fact, if we didn't have Trump messing around with tariffs the whole time, I'd be sat here, and you'd probably be sat here as well, Ryan, going, this is about as Goldilocks an economy as you could ever see. We've got very, very solid underlying growth when you strip out all of the tariff nonsense. We've got a pretty tight labour market, and we've got disinflation progressing very, very rapidly and in pretty immaculate fashion. But of course, you've got those tariffs, which leads to uncertainty, and that is just leaving businesses and consumers somewhat paralyzed. And I think the labour market reflects that. We're in a market where the pace of hiring might be slowing, but the pace of firing isn't really picking up. And you can see that from the continuing jobless claims data we had last week, which was at a cycle high. So it's just this kind of degree of inertia that we're seeing pretty much everywhere in the US economy at this moment in time. But back to that labour market report on Friday, I don't think, no matter what the data says, I don't think it's really going to change the Fed's mind too much. They are firmly in wait and see mode. And I think any easing before the fourth quarter is a very, very long shot indeed. And I think for financial markets, it's still a case of if the data's good, well, it's good data. The economy is still resilient. Let's move on. If the data's bad, it's a case of, well, it must be skewed by tariffs. So let's shrug it off and crack on with the weekend. But of course, we will wait and see what happens on Friday afternoon while Ryan is cooking the proverbial books on his sweepstake.
Do you want another one? Do you want another one?
You get in the same match.
You can do. Well, in my match you can. In my rules, man. You might break some records. We've been saying for months and waiting for months. When's it going to tip over? When's the jobs market going to tip over? As you said, jobless claims, they haven't shown any inkling. This is probably the longest run I've known of jobless claims not even showing any sort of wobbles at all, and that's pretty unusual. But yeah, I'm wondering, that consensus being quite tight, 85,000 between top to bottom, is that maybe a bit of complacency creeping in from economists that there are no wobbles coming? Because that would be the perfect time when people picking the numbers, their guesses are getting a bit complacent to get a dodgy one and knock them all out the park. So that's just an off the cuff comment about that. But yeah, I'm not
really have been on it today about forecasts, haven't you?
Yeah, really have. But yeah, I mean, the way to trade this one, and really the way the markets are at the moment, is you've got to see what the market's doing going into the number. I mean, take today as we're recording this, we've got ISM, we've got the dollar in a very, very bad, sticky spot at the moment, very, very weak. If we get good numbers from the ISM, then any rally you get in the dollar is likely to be hit, just because that's what the market's doing today. Come Friday, it could be a different story. We could have had a reversal from Trump. Everything's tickety-boo, positive news out of Ukraine, and suddenly risk is looking much better. And then if you get a good NFP report, it's going to go, yeah, everything's fine and dandy. And then you see stocks rally, the dollar rally, and everything else. So I can't sit here today on a Monday as record this and say this is what the dollar will do on Friday, whether the data's good or bad. You have to take what the market is doing at the time going into the report, and then judge your expectations for the data, good or bad, off the back of that.
Yeah, no, I think you are absolutely right on that one. Certainly trying to call the direction of the dollar is now on Friday afternoon is a very, very difficult one, as is trying to predict the non-farm payrolls number now for Friday, which is why I will wait until later in the week and before my guess is submitted.
Didn't I beat you last month anyway with your models and your whatever is your seaweed that you look at?
Well, I don't know. According to you, you beat me every month. When you're adjudicating your own competition, it's rather you're marking your own homework, so to speak.
My guess is they're in black and white. Thank you very much, as they will be shortly. So anyway, let's move on before you dig yourself a deeper hole.
Go on you go.
Yeah, well, I'm going to move it on to talking about stocks and US stocks and potentially restoring confidence in the US, as we've been talking about earlier this show. One thing that has struck me over the last few days is there seems to be a bit of divergence between global stock markets. They're all pretty much the same beast at heart and follow whatever direction the risk wind is blowing, but we've definitely got some differences I've seen creeping in. For one thing, US stocks recovered from that April clear out, but they seem to be struggling over the last couple of weeks to have a proper crack at those all-time highs. And that's all while, you have the likes of Germany, whose magic money tree fund and loosening debt break has seen a DAX notch new all-time highs, all while the economy still has its face pushed in the mud. Even UK stocks, and I'm not just talking the FTSE 100, the rest of them, the 250, all the stocks you look at, we're in touching distance of all-time highs. So for Europe, the underlying driver there is overall economic activity. But in the US, I think stocks are really now reflecting investor confidence. And yes, we've had decades of rallying, which is always going to find dip buyers. But whether we go on to those new highs is really down to how money feels about Trump right now and his policies. And I think he's done a lot of damage to that confidence. Of course, if we go to new highs fairly quickly, that lack of confidence will evaporate quicker than a goldfish's memory. But if he continues to be this erratic with policy, I can see a further erosion of that confidence. That could get worse for the stock market and set in play what could be a significant downtrend. So something not flash crashy like we saw in the prior dip, but something that starts really trending downward. But for me, the trade is pretty simple from here. If we fail again up into that 6K level, or even run up and fail into those prior highs, 6,100, 6,140, I'll be playing from the short side because I think if we top there again, that's going to be a pretty strong signal. But if we do go and break the prior highs, we're probably off and running again, and so I'll be looking for longs, and who knows, 7K might be the number, and at least I'll be getting a free lunch out of it, won't I, Michael?
Why? Where are you going with that?
Well, we've still got that bet on, haven't we? 6,100. Oh, here we go. Oh, the memory loss kicking in.
You know how you mentioned goldfish a moment ago?
I'm going to check the recordings, mate. It's all on tape.
No, don't you worry. Don't you worry. I'm a man of my word. If that bet is lost, then lunch will be duly settled. You have nothing to worry about on that front. And rather annoyingly, since we made that bet, I've become increasingly bullish on equities and actually thinking that you are probably going to end up cashing in that little luncheon voucher. So you can go and look up a menu somewhere. But sorry.
We'll go for some tacos.
Oh, absolutely. They're nice and cheap as well. On a slightly more serious note, this goes back to, actually, I think I put this chart in the last episode we filmed about a fortnight ago, where you've got this big disconnect between the S&P 500 and the value of the dollar, which to me suggests that actually a lot of the buying interest we've seen in the United States, excuse me, has come from domestic investors as opposed to international investors. And you would then logically extend from that and say, well, those international investors are instead putting their funds to work in either domestic markets, their domestic market, or other markets in the rest of the world, which is why we see this little divergence beginning to creep in. The other thing that is worth bearing in mind, and a number of questions I've had on this over the last week or so, is frankly ridiculous, is this Section 899 of the big, beautiful bill that is going through Congress in the States at the moment. Now, I appreciate that sounds incredibly niche, but the short version of what this section of the law would do is potentially result in very, very punitive and very, very high tax rates on international investors if the United States believes that their country engages in unfair tax practices. So, for example, if you're a French or a German or even a British investor investing in the United States, we have digital services taxes, or we're about to have digital services taxes in our countries. The US view that as unfair against their big tech firms, so they would impose somewhere between 5 and 20% tax on the income that those investors would earn on their US holdings, be that equity, be that bond, be that some sort of private credit. Now, I think that, again, just given how many people have started talking about this over the last week or so, that's probably also playing on a few minds and also contributing to the relative unattractiveness of US markets compared to those in the rest of the world. Now, that's not to say that Wall Street can't continue to rally. It absolutely can, and indeed it is. That's what we're seeing at the moment. Dips are being bought. But what it is to say is that the relative play might be, contrary to the last decade or so, by the rest of the world, because it's going to outperform, and maybe play the US as a relative short, as opposed to what we have been doing, which is the other way around.
Yeah, absolutely. And that was a very good post you put out, by the way. So kudos for that. And I suggest you pop a link up somewhere so people can read about that.
Thank you, mate. I will indeed. There we go. You can post the picture of me as a German journalist, and I'll post the quality market intelligence in the description. In the meantime, let's get on with our plays of the day. Right, two FX plays for you this week. I'm looking at the euro first of all. Now, I will warn you that since I created this chart yesterday, we are trading, well, where is spot now? About 114.10. So we are just north of the level that I'm going to mention in a moment. But fundamentally, the foreign exchange space of late has been one where we've been in relatively tight ranges. As you can see, euro dollar between sort of 111 and 115, 116 for the last kind of month, 6 weeks or so. And actually in a mindset where mean reversion has perhaps been the most obvious play. And I think that just exemplifies a bit of a lack of conviction among market participants. And frankly, who could blame them when the entire outlook could be turned on its head on the back of whatever Trump has to say on social media next? That said, because we've been in these ranges for quite some time, they have now become relatively well defined. So we can use them in terms of a trading strategy. Now, looking at the euro specifically, we remain north of the 50-day moving average, and we have, as I just mentioned, traded north of this 114 figure on an intraday basis. So I think now we'd be looking to play this from the long side. The cycle high is coming at 115.75, and that stands as the obvious target to the upside. Maybe the 115 figure could be a bit of psychological resistance in the meantime. On the flip side of that, if we were to get a close below the 50-day moving average, which is probably 112.20-ish now, just from some back of the envelope maths, then you would be looking to potentially flip short and targeting a run back down towards the 111 mark. So very much a range trading play this week. I don't see either of those boundaries breaking particularly soon, but nonetheless, potentially some opportunity in there in the meantime. Ryan, dollar yen for you.
Yeah, dollar yen, and I've got to start with a bit of disclaimer first, because as I'm recording this, I'm actually short dollar yen from up around 146. So I'm looking closely at my zone down below 141.70, 142, which is a real big one. That could be an area where I maybe look, and touch wood, I get a chance to square up my square up my shorts, and even maybe flip long as it's such a big level. Or else, if it breaks, to potentially add to my shorts or go with a fresh short on that break, particularly if it confirms the break. Now, as these markets can change their mind like a light switch these days, I'm going to be nimble while also hoping that this analysis lasts a few hours until you actually get to see it. But either way, the 142 zone is one that you can trade in the short term or use as a big pivot level to define the next real direction for the market. So, yeah, that 142 zone is going to be a biggie for me.
Very good. Well, let's keep our fingers crossed that this does last the 12 hours or so it will take for this video to make its way into the public domain. In any case, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Relied and Forex Analytics for joining me. Thank you to our producer as well, Kyriakos, for bringing things together as brilliantly as always. Hopefully, you have enjoyed the show. If you have, please drop a like on the video. Leave a comment as well. Let us know how you're trading the markets, and maybe even drop your NFP guess in the comments as well. We'll see how they fare this time next week. And that is when we'll be back with another episode of The Trade-Off to make sense of everything that has happened and whatever Trump has said next. In the meantime, have a very good week ahead, and we'll see you in a week's time. Thanks as always for watching. Goodbye for now.